You've probably heard that old saying, high risk, high reward. But what does that actually mean for your investments?
Oh,
Today, we are going like deep diving, into the world of risk and return
yeah,
in the stock market.
the stock market.
We've got some excerpts from a finance textbook kind of to guide our conversation today, and we'll be focusing on, how risk is measured,
Okay.
how it relates to the cost of capital,
Uh-huh.
and the role that diversification plays
Okay.
in building, like a strong portfolio.
Yeah, I think, understanding these concepts
Yeah.
can be incredibly empowering.
Yeah.
It's not just about picking winning stocks. It's
Right.
about making these informed decisions
Right.
that align with your personal risk tolerance,
Exactly.
your financial goals.
Absolutely. And it's more fascinating than you might think.
Yeah.
We'll be unpacking things like standard deviation,
Yeah.
a way to quantify risk,
Hmm.
and exploring how seemingly risky assets like gold can actually make your overall portfolio less risky.
Very.
Then.
Let's start with the cost of capital.
Okay.
It's a fundamental concept in finance that represents the return that investors expect for putting their money into a particular investment,
Right.
given the level of risk involved.
So it's not just about the potential gains,
No.
but also about the risk that you're taking on to achieve those gains.
Exactly. And this ties into the idea of opportunity cost.
Okay.
Every investment decision
Uh-huh.
means foregoing other potential investments.
Right.
The cost of capital reflects the potential returns you're missing out on by choosing one investment over another.
The textbook uses a great example with Starbucks stock to show how returns are calculated in the real world.
Yeah.
It breaks down the different components of return, including
Okay.
dividend income and capital gains or losses.
Mhm.
But I'm curious,
Yeah.
in today's world of high inflation,
Right.
how do we reconcile nominal returns, which are the straight up numbers,
Yes.
with the real returns that actually reflect our purchasing power?
That's a crucial point.
Yeah.
Inflation can significantly erode the value of your returns over time.
Right.
To get a true picture,
Yeah.
we need to adjust those nominal returns for inflation,
Okay.
giving us the real rate of return.
Gotcha.
That's the return that actually matters when it comes to growing your wealth.
So it's not just about how much money you make,
Right.
but how much that money will actually buy you down the road.
Exactly.
Now, the text also dives into market indices like the Dow Jones Industrial Average and the S&P 500.
Right.
Can you give us a quick overview of what these indices are and why they matter to
Yeah.
the average investor?
Market indices are essentially benchmarks that track the performance of a group of selected stocks.
Okay.
They give us a snapshot of how the overall market is doing.
Gotcha.
The Dow Jones, for example, tracks 30 large, well-established companies,
Okay.
while the S&P 500 includes a broader range of 500 companies weighted by their market capitalization.
So the S&P 500 is considered a more representative index for the U.S. stock market as a whole.
Right.
But how can an investor actually use this information
Yeah.
when making decisions about their own portfolio?
Indices serve as valuable yardsticks for comparison.
Okay.
You can assess how your own investments are performing relative to the broader market.
Mm-hmm.
If your portfolio is consistently lagging behind the S&P 500, it might be time to reassess your strategy.
That makes sense. It's like having a scorecard to see how your team is stacking up against the league.
Yeah.
Now let's talk about the historical relationship between risk and return.
Okay.
The text cites some fascinating research by Dimson, Marsh, and Staunton,
Uh-huh.
who analyzed U.S. Treasury bills, bonds, and common stocks from 1900 to 2016.
Right.
What did they find about long-term performance?
Their findings reinforce a fundamental principle.
Okay.
Higher risk assets, like stocks, have historically delivered higher returns over the long run
Right.
compared to safer assets like Treasury bills.
Uh-huh.
But it's crucial to remember that higher returns always come with increased volatility.
Yeah.
Your investments will experience greater fluctuations in value along the way.
So it's a trade-off.
Yes.
You can potentially earn more, but you need to be prepared for a bumpier ride.
Right.
The text also mentions the dot-com bubble burst in 2002
Yeah.
and the financial crisis of 2008 as examples of market volatility.
Right.
But how can the average investor learn from these historical events
Yeah.
and apply those lessons to their own portfolio decisions?
History often rhymes, even if it doesn't repeat exactly. By studying these past events,
Yeah.
we can understand the factors that contributed to those market swings
Yeah.
and how different asset classes responded. This knowledge can help us develop more robust investment strategies that can weather future storms.
So it's about recognizing patterns and developing a long-term perspective.
Absolutely.
Now let's delve into this concept of market risk premium.
Okay.
It sounds a bit technical, but it's essential for understanding how investors are compensated for taking on risk.
Sure.
Can you break it down for us?
The market risk premium is the additional return that investors expect to earn for investing in stocks compared to risk-free assets like treasury bills.
Okay.
It's basically the compensation for enduring the uncertainty and volatility of the stock market.
Okay, so it's the premium you demand for taking on the extra risk.
Exactly.
The text provides some examples from 1981 and 2016 showing how expected market return is calculated using current treasury bill rates and the historical risk premium.
Yeah.
But I'm wondering, isn't the historical risk premium subject to change?
Right.
How can we be confident in using past data
Yeah.
to predict future returns?
That's a great question.
Yeah,
Estimating the market risk premium is not an exact science.
right.
It involves assumptions and interpretations of historical data.
Uh-huh.
While the historical risk premium provides a useful starting point,
Yeah.
it's important to recognize that investor expectations and market conditions can shift,
Right.
potentially influencing the risk premium going forward.
So it's a moving target,
It is.
which makes it even more important to understand the tools we use to measure risk,
Right.
like variance and standard deviation.
Yes.
These sound a bit intimidating, but the text attempts to explain them in a straightforward way.
Sure.
Can you break it down for us and
Yeah.
perhaps go beyond the coin toss analogy to illustrate how these concepts apply to real-world investing?
Absolutely. Variance and standard deviation are statistical measures
Okay.
that quantify the spread or dispersion of possible outcomes.
Uh-huh.
A higher standard deviation indicates greater uncertainty
Okay.
and therefore higher risk.
Okay.
Imagine you're considering two stocks, Tesla and a bond ETF.
Okay.
Historically, Tesla's stock price has been much more volatile than the bond ETF.
Uh-huh.
This means Tesla has a higher standard deviation, reflecting greater potential for both big gains and big losses.
Okay.
Right.
Yeah. Yeah.
So if I'm looking for a potentially higher return, but I'm also wary of big swings in value,
Right.
standard deviation becomes a crucial factor in
Yeah.
my decision-making process. Precisely. It helps you quantify that risk
Uh-huh.
and compare the potential volatility of different investments.
Okay.
And this leads us to one of the most powerful tools for managing risk,
Okay.
diversification.
Ah, diversification. The idea that you shouldn't put all your eggs in one basket.
Exactly.
The text mentions an analogy with umbrellas and ice cream.
Yeah.
But I'm curious, what are some practical ways our listeners can apply diversification to their own portfolios?
Diversification is about spreading your investments across different asset classes
Okay.
that tend to react differently to market events.
Okay.
For instance, stocks and bonds often move in opposite directions.
Okay.
When the stock market is booming, bonds might lag behind.
Mm-hmm.
But during a stock market downturn,
Right.
bonds can provide stability.
So it's like having a balanced diet for your portfolio,
Exactly.
ensuring you're not overly exposed to any single asset class.
That's right. And within each asset class,
Okay.
you can further diversify by investing in different sectors, industries, and geography. For example, within stocks, you might consider holding a mix of large cap, small cap domestic,
Okay.
and international companies.
This makes sense. But the text takes this concept a step further,
Yes.
talking about the power of negatively correlated assets.
Right.
Can you explain what this means
Sure.
and how it can enhance diversification?
Negatively correlated assets tend to move in opposite directions.
Okay.
When one goes up, the other goes down.
Okay.
The textbook provides an example with a car company and a gold mining company.
Okay.
The car company's performance is tied to economic growth,
Uh-huh.
while the gold mining company often does well when the economy is struggling.
So by combining these two seemingly risky assets,
Yeah,
you can actually create a portfolio that's less volatile overall.
that's right. When the car company is thriving, the gold mining company might be lagging,
Right.
and vice versa.
Yeah.
This smoothing effect can reduce the overall ups and downs of your portfolio.
That's fascinating. So it's not just about diversification. It's about strategically selecting assets that complement each other.
Right.
The text visualizes this concept with something called the investment opportunity frontier.
Yes.
Can you explain what this is and how it helps us understand the relationship between risk and return?
The investment opportunity frontier is a graphical representation of different portfolio combinations
Okay.
and their corresponding risk-return profiles.
Gotcha.
It's typically depicted as a curve
Uh-huh.
with risk on one
Oh,
axis
okay.
and expected return on the other.
Okay.
The shape of this curve is influenced by the correlation
Right.
between the assets in the portfolio.
So a portfolio with negatively correlated assets would have a different shaped frontier
Yeah.
than one with assets that are positively correlated.
Exactly. A portfolio with negatively correlated assets will typically have a steeper frontier,
Okay.
meaning you can achieve a higher expected return for a given level of risk.
That makes sense. Now, the text also makes a distinction between specific risk and market risk.
Right.
Can you break down these two types of risk and explain why this distinction matters for investors?
Specific risk, also known as diversifiable risk, is the risk associated with individual companies or industries.
Okay.
It stems from factors like a company's management, product development,
Right.
or competition within its industry.
Okay.
Market risk, on the other hand, is systemic risk
Yeah.
that affects the entire market,
Okay.
driven by factors like interest rates, inflation, and economic growth.
So specific risk is like a microstorm that might hit a particular company,
Yes.
while market risk is like a macrostorm that impacts the entire economic landscape.
That's a great analogy.
Yeah.
And here's the key takeaway. Diversification can significantly reduce specific risk,
Okay.
but it cannot eliminate market risk.
So while we can mitigate company-specific risks by spreading our investments,
Right.
we can't completely escape the broader forces that shape the market.
Right.
The text highlights this point with figure 11.8, showing how diversification quickly reduces specific risk, but has limited impact on market risk.
Exactly. That's why it's crucial to have a strategy for navigating those inevitable market downturns.
This brings us to the thinking messages from the text,
Okay.
which distills some of the key insights for investors. Message 1 states that perceived risk can be mitigated through diversification.
Uh-huh.
The book uses an example of oil well exploration to illustrate this.
Right.
Can you walk us through that example?
Sure.
And explain how it applies to the average investor?
Imagine you're a manager at an oil company,
Okay.
and you propose drilling in a new unproven area.
Okay.
To you, this might feel incredibly risky,
Yeah.
but from the company's perspective, they're drilling hundreds of wells across the globe.
Uh-huh.
The risk of this single well is diversified away
Right.
within their vast portfolio of exploration projects.
So what seems highly risky at the individual level
Yeah.
becomes less daunting when viewed from a broader perspective.
Exactly.
How does this apply to someone building their own investment portfolio?
By diversifying their holdings, investors can similarly reduce the impact of any single investment's performance
Uh-huh.
on their overall portfolio.
Right.
This allows them to take on a bit more risk,
Hmm.
potentially increasing their overall returns over time.
That's a great way to frame it. It shifts the focus from individual stock picking to building a well-diversified portfolio that can withstand those inevitable ups and downs.
Right.
Message 2 emphasizes that investors in diversified portfolios are primarily concerned with market risk,
Yes.
not individual project risks.
Right.
Can you elaborate on why this distinction is so important?
When you hold a diversified portfolio, the performance of any single stock becomes less relevant.
Okay.
What matters most is how the overall portfolio is positioned to navigate
Right.
those broader market forces
Yeah.
that we can't diversify away.
So it's about understanding your overall exposure to market risk
Yeah.
and making sure it aligns with your risk tolerance and investment goals. Finally, message 3 states that market risk can be estimated by analyzing how sensitive a stock is to overall market movements.
Right.
Can you explain this concept and how investors can use this information to make informed decisions?
This concept is known as beta.
Okay.
It measures how much a stock's price tends to move in relation to the overall market.
Okay.
A beta of 1 means the stock tends to move in line with the market.
Gotcha.
A beta greater than 1 indicates the stock is more volatile than the market,
Okay.
while a beta less than 1 suggests it's less volatile.
So investors can use beta to gauge a stock's sensitivity to market fluctuations.
Yes.
And factor that into their portfolio construction.
Right.
This is incredibly valuable information for understanding and managing risks.
Exactly. It helps you make more informed decisions about which assets to include in your portfolio
Yeah.
based on your desired level of risk and potential return.
It seems like we've uncovered like a whole toolkit for, understanding and managing risk as we
Yes.
wrap up this deep dive. I'm wondering if there are any other practical tips or
Yeah.
insights our listeners can use to build, a more resilient portfolio.
One crucial aspect we haven't explicitly addressed is the importance of aligning your investment strategy with your time horizon.
Right.
Someone investing for retirement decades from now can handle more volatility
Right.
than someone saving for a down payment on a house in the next few years.
That makes perfect sense. Your time horizon significantly influences how much risk you can comfortably take on.
Right.
Are there any other factors that play a role in
Yeah.
shaping an individual's investment approach?
Absolutely. Your specific financial goals are paramount.
Okay.
Are you investing for growth income or a combination of both?
Right.
Are you primarily focused on preserving capital or maximizing returns? Clearly defining your goals will guide your asset allocation and overall investment strategy.
So it's not just about understanding risk and return in the abstract.
Right.
It's about connecting those concepts.
Yeah. To your personal circumstances and financial aspirations.
Exactly.
As we bring this deep dive to a close,
Okay.
I want to recap some key takeaways for our listeners.
Sure.
We've covered a lot of ground.
We have.
From measuring risk
Uh-huh.
to understanding diversification and market dynamics.
Yeah.
What are the most important things our listeners should remember as they navigate the world of investing?
I think the most valuable takeaway is that building a successful portfolio
Yeah.
is a multifaceted process.
Okay.
It requires understanding your risk tolerance,
Right.
aligning your investments with your time horizon and financial goals, and embracing diversification to mitigate specific risks.
And it's not a set it and forget it endeavor.
No.
The market is constantly evolving, so staying informed,
Yeah.
being adaptable,
Right?
and periodically reassessing your strategy are crucial for long-term success.
I completely agree. Investing is a journey,
Right.
not a destination.
Yeah.
It requires ongoing learning adaptation.
And a willingness to adjust your course as needed.
This has been an incredibly insightful exploration of risk and return.
It has.
I feel like I've gained a deeper understanding of
Yeah.
how these concepts work and how I can apply them to my own financial decisions.
Right.
Thank you so much for sharing your expertise with us today.
It's been my pleasure.
Yeah.
I hope our listeners feel empowered to take control of their financial future
Yeah.
and make informed decisions that align with their goals and aspirations.
And for our listeners out there, we'll leave you with this final thought. If you could wave a magic wand
Okay.
and design your ideal investment portfolio today,
Mm-hmm.
what would it look like?
Yeah.
Would it be a mix of stocks, bonds, real estate, or
Yeah.
something more exotic?
Yeah.
And how would you balance risk and reward to achieve your financial dreams?
There's no right or wrong answer.
Right.
The beauty of investing is that you can tailor your approach to your unique circumstances and goals. The knowledge and tools we've discussed today can help you make those decisions with confidence and clarity.
Thanks for joining us on this fascinating journey into the heart of risk and return.
Yeah.
We hope you've gained valuable insights to help you navigate the exciting and sometimes
That's-
unpredictable
Yes.
world of investing. Until next time, keep those minds curious and those portfolios balanced.
Sounds good.